In this video, I want to talk about how to account for restricted stock awards. Restricted stock is a type of compensation that companies give to their employees, typically to the CEO, the CFO, and other executives. It's restricted in that it can't be sold during the restriction period. So if you give a CEO restricted shares with a 5-year restriction period, that means that the CEO can't sell the shares, transfer them, or get any money for them for 5 years. Now, if the employee, in this case the CEO, were to quit or be fired during that 5-year period, they would forfeit the shares and not get to keep them. Now, restricted stock is recorded as compensation expense, so it's going to reduce a company's net income in its income statement. So let's do an example, and I'm going to walk you through the journal entries that a company would do if it had a restricted stock award. So let's take the company Turtle Anxiety Pillows, right? Because we know the world needs more anxiety pillows that are shaped like animals. And it grants 10,000 restricted shares to its CEO on January 1st, 2024. That is the grant date, okay? That's the date that the shares are granted and put in the name of the CEO. And the stock price as of that date, which is very important because that's going to be used to determine the amount of compensation being given, is $6 a share. So we have 10,000 shares being given to the CEO at a value of $6 a share. This is $60,000 of compensation. But you don't go and record $60,000 of compensation expense because we're going to record it over the restriction period, which in this case is 3 years. We also note that we have a par value of $1 per share. That will come in handy later, and you will see. Now, in terms of how would a company actually account for this with the journal entries, there are two valid approaches that a company could use. The first, which I think is the easier approach, results in no journal entry being recorded on the grant date, but then you're going to record compensation expense at the end of each period, and then you're going to make a final entry when the shares vest, which means that when the restriction period is over and the shares are given to the executive, or to basically the free and clear to the executive, right? The executive is given the stock up front, but it's not vested. Okay, we say vested like that the CEO could sell the shares, do whatever they want when they give them to their kid. So when the shares are vested, we're going to have a final journal entry under approach 1, but not under approach 2. Okay, so the main difference is there a journal entry on the grant date or not? And then is there going to be a final journal entry when the shares vest? So you'll see. Now, by the way, just a little caveat here, I'm going to ignore the tax implications of this. You could actually have a deferred tax asset being created and need to be recorded in the journal entry because you basically have the compensation expenses reducing the company's book income, their income per their financial statement books today. Right? But they're not actually getting a tax deduction, let's say, until the shares vest. I don't want to get into any of the taxes and stuff here today. We're just going to talk about recorded compensation expense. So under approach 1, I'm going to do all the entries for approach 1, and then we'll come back and look at approach 2 next. I have approach 2 over here in purple, okay, and then I have approach 1 here, but let's focus on approach 1. So the grant date under approach 1, which I think is the easier approach. Okay, you can focus on that one first if you find this complicated. No journal entry at all when the shares are actually granted. But remember, we said there was $60,000 of compensation given out, right? A $6 share price, 10,000 shares, and then a 3-year vesting period. So if you take $60,000, okay, the total compensation being given to the CEO, divide it by the 3 years in the vesting period, we see that is $20,000 a year of compensation expense. So we're going to debit compensation expense and we're going to credit paid in capital hyphen restricted shares. Okay, I put restricted shares in parentheses here because I didn't think I'd have space here. But normally you'd have paid in capital, then hyphen restricted shares. Okay, so you have this paid in capital account here. The important thing to note is this is an equity account. So this is actually, this is an equity account here that we are increasing. Okay, so we're debiting the compensation expense. That $20,000 is going to go on the income statement, reduce the company's net income. Now, we'll get to the other approach later, approach 2. Let's stick with approach 1. Now, we're going to have this same journal entry, right, where we debit compensation expense, credit paid in capital for the same amount. We're going to do it every year for 3 years. So that at the end of each year, for 3 years, we make that same journal entry. Now, when the shares actually vest, okay, when the shares actually vest at the very end, January 1st, 2027. Now, the 3 years are up. The restriction period is over. The CEO can do whatever they want with those shares now. They could sell them. They could do whatever. And so now what we're going to do is we're going to debit this paid-in capital restricted shares account. Okay, why are we debiting that for $60,000? We want to get rid of it because now we're going to increase the common stock account, and there was 10,000 shares at $1 par value per share. So 10,000 times 1 is 10,000. That's where that came up with. And then we have here, why is this debited for $60,000, this paid-in capital? We had credited it 3 different times for $20,000. So it had a balance of $60,000. So we're going to debit it for $60,000 because the equity account, debiting it will get rid of it, right? Reduce it. So we reduce the paid-in capital restricted shares, and then we say, you know what? Now we're basically reclassifying this equity. We're reducing the paid-in capital restricted shares and say, hey, it's no longer restricted. Now we credit common stock for the par value times the number of shares, and then the additional paid-in capital, that's just a plug. We had 60,000 in debits, 10,000 in credits, so we need 50,000 extra in credits to make this balance. So again, just reclassifying the equity from the paid-in capital restricted shares account, reducing that, and then increasing common stock and additional paid-in capital. So these are just now like normal shares. They're not restricted anymore. Now, if you're wondering, what if we didn't get to this point? What if at some point the CEO quit to take a position at another company, or they were fired or whatever before the 3-year restriction period was up? So that would lead to forfeiture of the share, right? You don't get it. You don't get the shares if you don't make it to 3 years. Okay, if you're not employed with the company at the end of the 3-year period, you don't get to keep the shares. So if the stock is forfeited, you would just reverse, as the accountant, you would reverse the prior journal entry. So let's go back. Let's say that so we got December 31st, 2024. We've made the first year. We debited compensation expense, credit, and paid-in capital. Let's say a few days later. Let's say I don't know, January 5th, 2025, the company, the CEO quits or is fired or something. So you would just reverse this entry here, where you would, remember, to reverse an entry, so we credited paid-in capital, we would now debit paid-in capital. We had debited compensation expense, we would credit compensation expense. So you just do the opposite of whatever journal, to make it like this never happened, basically. Okay, now, let's get to approach number 2, over here in purple. Now, approach number 2, we're still going to be recording $20,000 of compensation expense at the end of each period. That's still going to happen. But we are going to have, so where we had no journal entry before on the grant date, now we're going to have a journal entry on the grant date. We're going to debit this account here, unearned compensation. This is a contra equity account. Contra equity means it reduces stockholders' equity. So contra equity account, unearned compensation of $60,000. And then what we're going to do is every year when we record that compensation expense, instead of crediting paid-in capital restricted shares, we're going to credit that unearned compensation account until it basically goes to zero. So we initially debited it at $60,000, and then we're going to credit it for $20,000 every year for 3 years, and it'll be zero at the end when the shares have vested. So we debit this contra equity account, unearned compensation for $60,000. Okay, we credit common stock, 10,000. Again, it's 10,000 shares times $1 par per share. And then we credit the additional paid-in capital for 50,000. And again, if you're wondering why is this 60,000 for unearned compensation? Again, we had $6 was the share price on the grant date, and there were 10,000 shares being given out. So that's what we're basically saying. There's 60,000 of total compensation here. It's been unearned. Okay, so contra equity account, and then again, and under each approach, you're debiting compensation expense for $20,000 every year. It's just what you're crediting changes. Now we're going to reduce that unearned compensation account, and we do that 3 different times, right? There's this 3-year restriction period, and at the end, there's no journal entry under approach number 2. You see, before with approach 1, we had to credit common stock, credit additional paid-in capital at the end, right when the shares vested, but we don't have to do that with approach number 2. Why? Because we already, at the very beginning, we credited common stock, we credited additional paid-in capital, so we don't have to do that at the end under approach number 2. We don't need to make any kind of journal entry. We've already increased common stock and additional paid-in capital, whereas under approach number 1, we didn't do that at the beginning. We made no journal entry at the beginning. So on approach number 1, we had to get rid of that paid-in capital restricted shares account and then increase common stock and additional paid-in capital when the shares vest.